Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Well, it's no secret that over the last couple of years, people, especially in the multifamily space, have gone through quite the kicking in the market with interest rates, with floating rate mortgages, with insurance costs, with replacement costs, with labor shortages, with vacancies. Just a lot of stuff is going on in the market. So a challenge a lot of sponsors, a lot of operators are having these days is trying to talk with the lenders and get a little bit of flexibility, get a little bit of breathing room there for what they need to do. And also talking with their investors about some not so fun things, like having to put a pause on distributions or, heaven forbid, capital calls. So how do you navigate all of that? Well, today, my special guest knows all about this. Richard Crouch is an attorney who works with sponsors and operators and helps them with legal stuff. And today we're going to be talking about how to deal with lenders and investors when things aren't going perfectly. Richard, great to have you. Welcome to the show.
Thank you. I appreciate you having me on.
So, Richard, first things first, tell us a little bit about you and your company, where you're based, who you work with.
Okay, we're based in Virginia. I'm a partner at Woods Rogers, and I primarily focus in commercial real estate law, do a lot of business formations in connection with setting up real estate deals. But basically, anything that touches on commercial real estate, we handle, and I've been at it for about 25 years, and I've been at the same firm that entire time.
Wow. All right. So you've seen a few cycles already. How does this one compare to anything that you've seen personally over the last 25 years?
It's interesting. It's been more protracted for me. I was still a young attorney when the GFC happened, and I was a young partner, and I was fairly siloed. So I was doing all of my own work, and now I'm more of a leveraged practice because my practice has grown. But when there is a contraction in transactional volume, you notice it much more quickly. And so I have more responsibility for more people than I did back in 2008. And so I'm also looking to feed the younger attorneys that work as part of my team now. So it's the fundamentals are different as to why this has happened, but the transactional volume is still noticeable. And I think we definitely have been doing a lot more workout scenarios under this particular cycle than we did with the GFC. Because the assets, I think, are on more solid footing.
Well, let's talk about that whole workout process, because again, unfortunately, a lot of people are kind of in that situation. Some folks are playing the ostrich and just sticking their head in the sand and hoping it all works out, and it doesn't. And they end up going belly up and the deal goes south and all that kind of stuff. So how do you help operators kind of deal with the crap they're going through right now, especially with the banks and the lending institutions and that side of things? How are you able to help them get a little bit of breathing room there?
I get involved with them fairly early in the process when they're starting their dialogue for a servicer, for example. And the recurring theme is for them to have very active, clear communication with their servicers and to really come to the table with a solid plan if they're in a workout scenario. It could be an issue where they're just not meeting their debt service covenants. They could be trying to access reserves, or they maybe had a maturity date that's come and gone and they need more time to either refinance or possibly sell the property.
So do you find that some folks are making the mistake of relying on the servicer to come up with a solution instead of the other way around?
Very much so. Very much so. And servicers are very busy, and they have very minimal incentive to deal with the borrowers. I mean, they're going to deal with the biggest fire first. But they do put a lot of the they don't want to negotiate against themselves, and they usually want a fair proposal from the borrower. So it would not be uncommon. I mean, if they're going to give an extension, they usually want something in return. So it might be a principal pay down. It might be other enhanced credit components. It might be getting an additional guarantor. They want something that's going to also put them in a better position if they're willing to work with the borrower. And
Okay.
and
Well,
we
it makes
have
sense. Banks are very rarely super generous with
very
conditions.
true.
Yeah. Okay. So Richard, without sharing names or anything confidential, obviously, could you walk us through an example of a client that you've worked with relatively recently who's kind of done this process with you, and maybe tell us the story, paint me the picture of how what situation they found themselves in, what you did with them, how it ended up for them.
Yes,
Hopefully a happy story.
it is, and they have, even if you're able to work out something with the servicer, it doesn't mean that's the end of the story. You may very well have to revisit it in six
Mhm.
months or 9 months, depending what your extension was.
Right.
But one circumstance is we had a client who was trying to access certain reserves for tenant improvements that the lender basically had under lock and key, and they were having a lot of trouble with responsiveness from the servicer. And then during that whole process, the servicer found out about one issue where completely accidentally the borrower had breached a carve out provision. And for those listeners, the carve out
Yeah.
provision
For
is
those of us that don't know what the heck that means, what is a carve out position?
there will oftentimes be if you have a non-recourse situation in terms of guarantor
Right.
liability, you might still have a document where there are these certain, they call them bad boy events or bad boy carve-outs, where if you do things like misappropriate funds, you fail to pay your insurance premiums, anything that could really jeopardize the ability of the lender to levy on their collateral, those might
Mhm.
be situations where you open yourself up to personal liability. And
Okay.
this one client, again, it was a very minor thing, but they had done some internal structuring with some of their principals. And if you took a pretty broad interpretation of the language of the loan documents of the guarantee, it could be deemed as an unauthorized transfer. And
Mm.
that's a situation where a servicer is going to want some default interest, and they're going to want you to basically proffer a certain, an out-of-pocket payment to be put back into good standing with the lender to access reserves and to keep your asset viable. And you have to do that whole dance while keeping your
I'm
investors.
sorry, I'm laughing because it just sounds like a bank, for crying out loud. Any way they can screw you, they do. That's what I'm hearing between the lines
Bottom
there.
line, bottom
Yeah,
line.
yeah. Okay, sorry. Please continue with the story.
But in doing so, you also have to keep your investors informed
Yeah.
because it's probably no mystery that returns or preferred returns are not being paid to investors. They're wondering what's going on and having to actively communicate with them as well. And a lot of that has been just having a clear message, having a clear plan, being very well organized, and trying to stay ahead of the problem and being proactive instead of reactive to situations like that, and in terms of dealing with both the servicer as well as your own investors.
So, what are some of the bigger mistakes you're seeing people making these days with investor communication, communicating with their LPs?
Sticking your head in the sand is the absolute
Yeah.
worst thing you can do. And a lot of people just have this misguided notion that if you ignore the problem, it will somehow magically resolve itself. And we've certainly had situations where clients who are sponsors that tend to be pretty above board have kept themselves really out of trouble because they've been so diligent about investor reporting and communicating with their investors. And if there is a problem, say there was a large tenant that vacated early and that's affected
Mm.
cash flow, telling them this is what's happened. This is who we're talking to remedy the situation. This is how we're going to remedy the situation, and keeping them in the loop about that is critical. Or, for example, with this servicer default I was talking about, where they're having to pay basically default interest to get back on steady footing, and also trying to get the property viable so that it performs, and talking about additional capital that may be
Mm.
required. And you definitely have to have a very clear explanation as to why additional capital is needed. Obviously, investors don't like hearing
No,
that,
not at
but
all.
sometimes to save their initial capital, they may be willing to contribute additional capital, but they want to make sure that they're not throwing good money after bad. And So that's a very key situation too, in terms of being forthright and transparent, and really just having a long-term perspective, because your reputation, particularly as a sponsor, is very much your currency, and
Yeah.
you need to be in it for the long game. Very rarely do people achieve total success after one or two one-off deals. You need to be looking at investors like future investors down the road, not only for their own capital, but for word of mouth with other capital sources in the community.
So, Richard, have you had to have the unpleasant task of working with some of your clients through a capital call situation? Yeah.
We have, and
Yeah.
fortunately, it's been very interesting during my trajectory or my path in my career. When we first started doing syndication deals, and it would have been the early 2000s for me, about 2002. And actually, in a lot of those operating agreements, investors were very clear that they wanted a provision saying there would, under no circumstances, be additional capital or capital calls.
Mhm.
And that actually back then was the norm. Now, over time, we worked in a lot of provisions that really laid out the mechanics of how you give notice for capital calls when they're needed, and what happens if certain investors don't contribute, and how are their membership interests diluted. And and we've also worked out language too that makes it clear that there are very clear metrics of performance for the sponsor as well, because that was something in early operating agreements in the early 2000s. Standards of performance were pretty vague, but
Yeah.
now we have more clear set guidelines where if returns aren't met for maybe two fiscal quarters, the sponsor has to submit a business plan as to how they're going to improve the situation, so that there's less ambiguity. And it actually really protects both the investors and the sponsors to have more clear criteria um, like that. But yes, to answer your question, fortunately, now all the operating agreements we see have very clear mechanics for it. And when additional capital needs to be requested, it's a pretty clear path as to how to go about that. And most of our clients are savvy enough to explain the business side of it, but we help guide them through how you give the notice and how you make sure you consistently comply with your governing documents. And so it's definitely a relief when you need those provisions that they work out like they should.
Yeah. Well, so that dumb question, but basically, how does it work if they have to do a capital call? And let's say they're working with, for easy numbers, let's say it's 30 investors, 30 LPs in the deal, and five or six of those LPs say, screw you, Dave, we're not throwing good money after bad. What happens
So
in that case?
yeah, so the initial steps are they'll usually put together a memorandum, and there'll be a provision usually in the operating agreement that's clear as to how notice is given, what method you use. And the memorandum itself will be very clear as to what the history of the project or the issue is and why the additional capital is being requested. Usually there is a provision also in the operating agreement that says what happens if parties don't contribute, and usually they end up being diluted in terms of their membership interest. So what they initially put in basically ends up being worth less, at least on a prorated level.
Right.
Um, and sometimes you'll see operating agreements where they actually really want to incentivize people to do additional capital. So there might actually be a multiplier in terms of for every additional dollar of capital they put in, there might be a slightly higher valuation attributed to that. So that's one creative provision that I've seen as well. But usually, I would say at least 9 out of 10 times, now more than that, non-contributing members are usually going to have their interest diluted.
Well, because I'm assuming, and I could be wrong, I quite often am, Richard, but I'm assuming that, when things were go, go, go with multifamily in 18, 19, 20, 21, maybe even part of 22, it's like everybody's making money hand over fist. There weren't any cash calls. It wasn't a problem. And then people signed up for new deals and they overpaid and all that kind of stuff.
Right.
Chances are most of those LPs did not read the fine print with those offering memorandums, did not read about capital calls. It came as kind of a big shock and a surprise to them. Have you seen any of that?
Not to, I think more people are thankful and grateful that if an asset is struggling, that there is a path forward. You
Hmm.
are right that nobody tends to really question things um, too much when things are going well, but our approach has always been you write the agreement for the bad times,
Of
um,
course. Yeah.
and
But
so
most lay people don't read the agreements as well as they should. That's been my experience
yeah,
as a
that's
lay
true.
person.
And of course, they're always encouraged to have an independent review, but
Of
I'm
course.
certain there are
By the
times
way, they don't.
where they don't. They don't. As wealthy as some of the investors may
Yeah.
be, and with the financial wherewithal and which you would assume is sophistication, sometimes they don't. Particularly, like you were saying, if there have been a handful of successful deals that went
Yeah.
well, they may tend to discount or overlook some of those more mechanical provisions that are needed in the more trying times.
Well, I understand that every deal is different, but let's look at that example where everything's clearly laid out in the paperwork and everything. And let's say the minimum investment in a particular deal was $100,000. In your experience, like how much would a capital call be? Going to be different all over the board, but what's kind of the average you've seen for that level of an investor? So if they put 100 grand in, are they getting a capital call for another 100 grand, or is it 20 grand? Like what percentage of their initial investment does it tend to be?
I've never seen it quite to that level, and it may be that because a lot of these syndications have at least 30 investors in them, that it's more spread out. I have seen them as high as maybe 50% of their initial
Wow.
capital. That's
Mhm.
probably one of the more extreme cases I've seen. I've never seen basically doubling their initial capital. Um, I think that would that might be an asset that's beyond saving
Yeah.
at that point. But
Yeah.
but a lot of our clients that are sponsors do try to have conservative assumptions when it comes to capital. So a lot of the planning on that at the initial stage um, is a lot more thought out. So I think that's why you
Mhm.
don't maybe have the dramatic swings in additional
They've
capital.
got hopefully got a bit of a cushion in there already. Yeah.
Yeah, very true.
Makes sense. So, Richard, these days in mid 2026, who are you looking to connect with?
We can always assist people, and even though there's not a lot of transactional volume in terms of new acquisitions, the ideal client would be somebody like a sponsor, somebody who's putting deals together. Doesn't have to be a brand new sponsor. It can be an experienced person who, although they've slowed down from a transactional standpoint, they're taking the time now to basically dust things off, re-examine their governing documents to make sure that they have the control that they thought they have, re-examining their loan documents to make sure they're complying with all the covenants, making sure they have no exposure on carve-out guarantees, and any assistance they might need during this more quiet time. They also might have commercial leasing needs, which continue to go, even though we're not seeing as many acquisitions. So there always is legal work to be done. I had a colleague who joked that it's the type of work that keeps the lights on. It just doesn't pay your bonus. And there's never a scarcity of that type of work. There just might be a slowdown in a lot of the acquisitional volume because of
Understood.
interest rates.
So, hey, Richard, if people want to find out, connect with you, what should they do or where should they go?
I think the best resource would be to visit our firm's website, and you can find me on there. All of my contact information and background is on there, as well as articles I've written and so on. So it's the name of my firm is Woods Rogers. So it's basically www.woodsrogers.com. Both of those are plural. And if you go to Richard Crouch, my last name is Crouch. In the attorney contacts, you'll find out pretty much everything you need to know about me, and you can easily get in touch with me.
Fantastic. Richard, hey, thank you so much for being on the show. Thank you so much for explaining the not so fun side of things and how to kind of proactively communicate with lenders and with investors when things aren't going well. So I really appreciate that.
Thank you. I appreciate you having me on.
All right, everybody, thanks for tuning in, and we will see you again on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.u.com.